Well, welcome everyone. My name is Donna Rapiccioli, and I have the honor of serving as the Dean of Fordham's Gabelli School of Business. As many of you know, 2020 marked 100 years of purpose-driven business education at Fordham, and this Centennial Series was designed to shine the light on emerging trends and new forms of business disruption. Since our inception, we focused on embedding these trends into our programs to better prepare our students for the exciting disruptions that they'll face throughout their careers. I want to thank the Gabelli Center for Global Security Analysis for being our partner in the series. I'm very much looking forward to tonight's event featuring alumnus Michael Buchella, Gabelli School 2008, and Gabelli School faculty members Paul Johnson and Donna Riddell. There are many applications of blockchain and cryptocurrencies, but it may just be that decentralized finance, DeFi, and non-fungible tokens, better known as NFTs, will be the applications that bring this technology to a much wider audience. Today's session is going to focus on how DeFi and NFTs will challenge the established finance industry. It truly is my pleasure to introduce our panel. First, Michael Buchella is a partner at Block Tower Capital, an institutional crypto asset and blockchain technology investment firm. Professor Paul Johnson runs Nakusa Investment Advisors, an advisory firm focused on helping CEOs and boards of directors deal with operational and financial strategy, capital allocation, shareholder value creation, and corporate communications. And Donna Riddell is a businesswoman, professor of blockchain digital assets, an angel investor, and a philanthropist. Our speakers will participate in a fireside chat around these topics and share their insight and expertise. Following the discussion, we'll facilitate audience questions. We'll ask that you type them into the Q&A section near the bottom of the Zoom screen, and you can do that beginning now. Before I turn it over to Paul to start us off, I want to remind you that we rely on your philanthropy to deliver on our mission, so that I ask that you consider making a gift to the Gabelli School Centennial Fund. Now, it's my pleasure to turn it over to Paul Johnson.
Thank you, Dean. I very much appreciate being here tonight. More importantly, is I am very honored and proud to be part of the Gabelli team where we deliver crypto-related courses. We teach 4 courses at the graduate level. I teach one of them. Donna Riddell teaches one of them. I think Ben Cole might even be on this call. He teaches one of them. And then we teach a 4th class. I focus mostly on digital crypto, the traded tokens, and then a second mini course on business-related applications of blockchain. So what I'm going to do tonight is take a quick tour through a few slides. I don't like to scare everybody. We're going to go through 30 slides in 3 minutes to level set the way I think about what's going on, at least the current crypto markets, and then this will lead to a broader discussion. I believe Donna Riddell and Michael will also make some comments similar. All right, let's get going, go through it quickly. Blockchain, crypto is basically the intersection of technology and finance. And it's nothing more than that. It's the next generation of technology born out of many of the technologies we've seen before. And it really is coming directly at finance and other information-based applications. And it really got launched in the financial crisis of '08. One of my favorite pictures, Lehman Brothers in front of Christie's. In 2009, a unknown entity, person, individual named Satoshi Nakamoto published a paper. It's a very short paper. It's a very insightful paper. It's a very cool paper that he wrote. And what you see is that he wrote, he distributes his paper on really a little known cryptographic mailing list, and with a single line in the email that says, I've been working on a new electronic cash system that's fully peer-to-peer with no trusted third party. January 3rd of '09, they mined what is called the Genesis block of the blockchain. It's the first entry in the blockchain. And in that, he publishes the code. This is an open source project. He published all the code behind it. In the code, but not in the original paper, there's a 20 million limit on the number of Bitcoins. Why is that important? That creates scarcity. And if you create scarcity, the only thing you have to think about is demand. And that will be one of my themes. It took 7 days to mine the first block, and the first transaction was between Satoshi and a gentleman named Hal Finney, who subsequently passed away in 2014 of Lou Gehrig's disease. In the original Genesis block, Satoshi put in place this quote, which comes from the London Times. And it really has a double meaning. One, to timestamp this, the original block, so we would have that forever, but to also point out the failure of finance, because this was the second bailout for banks by the British Chancellor, which is very important. Now, Bitcoin came on the history of a lot of work in digital currency. In fact, depending on how you want to count the projects, it was either the 4th or 5th attempt. The first 4 which died didn't get very well. So the initial reaction to Bitcoin was not very overwhelming because there had been many programs before that, none of which were successful. Bitcoin is based on 4 key computer technologies that had been around for a long time. And if you look at it, really the genius is how the puzzle pieces were put together. I won't go into details here, but it's really the proof of work, which is this lottery ticket, which eliminates double spending, which is a problem inherent in all digital systems, plus a consensus mechanism based on what is called Byzantine fault tolerance, plus this reward system where you had a predictable monetary supply. And it was those pieces put together in such a way that it ended up being genius. And that's what Bitcoin is today. It comes with some costs, however. This is the hash rate that the miners use to solve that cryptographic problem we've talked about. And these are terahash rates per second. These are big numbers. I'm going to put this into numbers you probably understand, which is terawatts of energy. In February, the Bitcoin network burned up 81 terawatt hours on an annualized basis of energy just in the month of February. That's the size of a small European country, what they would do in a year. So Bitcoin has an energy problem, which is not going to go away. So what is Bitcoin? I've been teaching crypto for 4 years. I finally this week figured it out, and this is my answer. What is Bitcoin? It's a digital system that provides data and transactional integrity without a centralized, trusted third party. We've never been able to do that before. The system put together solved the double spending challenge that's inherent in all digital systems. As we know, making copies in digital systems is trivial. This system does not allow that. Bitcoin has a limited supply programmed into its code, 21 million, which creates its scarcity. And the value, and this is really the insight I had recently, the value comes from individuals projecting narratives onto Bitcoin and the technology's potential. And that's what you have. And so for people that struggle with what Bitcoin really is, that's the key. It is nothing, and therefore it can be anything. And there's the price. Digital asset volatility, which is what we deal with. These are fairly simple steps. Price of any asset quoted is the intersection of supply and demand. Supply is a function of the issuing mechanisms and is relatively fixed for most digital assets. Bitcoin has 21 million. So that fixes the supply side, scarcity. There are 2 types of demands. There's transactional demand and speculative demand. Transactional demand is relatively stable in the short run and takes a long time to build. And at the moment, there's very limited transactional demand in Bitcoin. So therefore, short-term price volatility is nothing more than changes in speculative demand. So Bitcoin today is a speculative asset. There's your fixed supply. We know what the inflation rate will be. It's about 1.75% a year now. So price goes up if demand grows faster than supply. In this case, if demand grows faster than 1.75%, the price will increase, as we've seen. Keep in mind that 95% of the Bitcoins are still owned by 2% of the holders. The rest of us own the other 98%. Also, this is very important. Currency is an intermediate good used in exchange, which means currency is a collective belief system serving as an exchange protocol. And because currency is an exchange protocol, it is at the point of exchange, which is effectively an act of faith. You hear this all the time about currency, that the value of an intrinsically worthless item, pieces of paper, becomes a reality. I put this all together because it's important to understand that users define currencies, not investors or speculators. So Bitcoin will become a currency when people start using it as a currency, not when investors and speculators tell you that it's a currency. All right, little thought process. There are 3 assets you can hold: orange one, a blue one, and a green one. The orange one goes up in value 5% a year. The blue one, its value never changes. This is all relative to purchasing power. And the green one decreases its purchasing power. So if you have an asset, the orange one, where the purchasing power is going to go up over time, meaning you can buy more things with it over time. The blue one is you can buy the same amount of things over time. It's inflation protected. And the green one is an inflationary currency. So it actually purchases less over time. Ask yourself, which asset are you going to hold as an investment? What asset are you going to use to transact in? It's pretty clear you'll transact in the green one and you'll hold the orange one. Well, guess what? The orange one is Bitcoin, the blue one is hard money, and the green one is fiat. Fiat currencies will always do a better job as a medium of exchange over deflationary currencies. All right, Bitcoin has value because it trades into more established currency networks, the RMB, the Euro, or the USD. That's where value comes from. There's almost no transactional demand. George Soros, one of the greatest hedge fund managers of all times, when I see a bubble forming, I rush to buy it, adding fuel to the fire. Soros and Morgan Stanley made a $200 million investment in a Bitcoin firm called NYDIG last year. Here are your Bitcoin bulls, the Wikivass brothers. They're the ones from Facebook. Paul Tudor Jones made a comment almost a year ago about Bitcoin. His average price, $11,000. Michael Saylor, the CEO of MicroStrategy, is making an inflationary bet with his Bitcoin purchase. Stanley Druckenmiller worked with Soros. He's making a supply and demand bet because he knows supply is fixed. Bill Miller used to be at Legg Mason, now runs Miller Value Partners. He's making a supply demand bet. One River Asset Management made a $6 million investment in the fall, the largest institutional investment at that point. They're making a supply and demand bet. And Elon Musk, I think he just wants the headline. All right, this is a positive convexity trade for you traders out there. Higher prices increases demand. Most asset higher prices decrease demand. All right, so just remember, final comments. Nothing the long-term bulls have said about Bitcoin has come true. It's not a currency, it's not a payment system, and it's not been tested as a store of value because there's been no inflation. However, it's been a spectacular speculative asset, and maybe the best in modern history. All right, so just a few comments to get started. Dean, I don't know whether you wanted Michael or Donna to chat net.
Donna, why don't you jump in?
Okay, hi, I'm very happy to be here, and it's fantastic to talk to students. I managed to actually have students on Friday night from various clubs at Fordham Business School talk with me, so it's great to be here again. I take a slightly different tact in teaching, and I do a little of it from my life experience. I've seen the nexus of technology and law and business come together many times. And the first time I really saw it was when I was on the trading floor and I was chairman of COMEX, and there was a product that was starting between the Chicago Mercantile and Globex that was going to do trading overnight. And of course, that would have in some way disrupted on a long-term basis, the people that trade on the floors. It was a long process. We did a merger, and today, lo and behold, there is no trading on floors. So sometimes you need to go through a lot of disruption in order to protect the jobs and protect the way of doing business in the future, not as it is today, in order to be able to modernize and have a whole industry that modernizes. And that went for the New York Stock Exchange and for all others. They're just backdrops now for CNBC or MSN. And so I say the same thing to students, which is, today in this cryptocurrency world, what are the opportunities? Where can you apply what you're learning? And how can you question and improve upon your learning in order to be prepared for the future? You still need your basics. So in law, you still need contracts and you still need property, and all of those things come to play very specifically in Bitcoin. In the business school, you still need to know about finance, and you need to know about accounting, and you need to know about analysis. And Michael will be able to speak to those things because that's what he does every day. And so going to school and learning these fundamental traits and these skills will be able to make you flexible for when new technologies and new businesses and startups and entrepreneurs that are growing every minute in this cryptocurrency world will be able to be open to you. And so I will have Michael talk a little bit about, the practical elements that he sees if the dean is ready for that.
Sure, I can pop in if that's okay, Donna.
Please do, Michael.
Excellent. And yeah, I mean, my experience in the Fordham community has been ever present. I found my way into Goldman Sachs during the depths of the financial crisis through an alumnus who helped guide me through that process when I was a graduate with one job prospect that I wasn't necessarily thrilled about, and then spent the next 10 years at Goldman Sachs and building out sort of my own businesses in the cross asset space, primarily in Canada, and was sitting on the trading desk at Goldman in 2017 with the S&P, not realizing at a 7 implied vol, and this new technology and asset class that I had been hearing about and sort of trading in for the last 2.5 years, kind of percolating and really, it was one of the few things that I think could have drawn me away from the traditional finance world. And so for me, it was very much a market before it was a technology. So that was the exciting moment for me, was when Bitcoin became more of a market. My partners in my hedge fund, and as a quick background, we run a large multi-strat hedge fund. We focus exclusively on the cryptocurrency space. We also do private investments in blockchain technology and cryptocurrency infrastructure companies. So we kind of look across the entire ecosystem. Obviously, Bitcoin is a large piece of that, but as in the title of today's sessions, there's other areas like DeFi and kind of an interesting time for the NFT segment, given we have one of the largest capital raises in the history of our industry today, with Dapper Labs closing a $300+ million round led by Coatue and Andreessen Horowitz. So it goes to show you that the generalist community is now really focused on our area as it grows out in scope. And so, I kind of looked at this space again as a market initially. It pulled me in. It was this hyper volatile, uncorrelated asset. And then once we launched Block Tower, I got pulled into the technology side, and it led me down the rabbit hole of things like smart contract protocols. Most of the folks in this call may have heard of something called Ethereum. That's kind of the de facto standard in smart contract protocols. There's alternatives to that. There's the DeFi space, there's the NFT space. And the way I kind of break down the industry today is you have Bitcoin as this macro asset that's being adopted by institutions as primarily a hedge, really a hedge of fiat debasement. And so you can say that is potentially an inflation hedge, but we really haven't seen inflation tick up just yet, so we can't say that for sure. You can say, and actually this is what the chief commodity strategist at Goldman Sachs correlated it to, as a retail reflation trade. So it actually aligned better with copper than it did with gold price. The other way to think about it is basically a hedge against central bank activity, which is, as everyone knows, has been kind of unprecedented since the pandemic. So that's sort of a, in my view, that train has left the station, and we've seen institutional adoption. Paul had mentioned a few of the larger players that have invested more recently. We talk with large CIOs of pension plans, endowments, foundations, sovereign wealth funds across the world. They are well established in terms of their underwriting of the asset and are just in the earliest stages of actually deploying. So that's the first vertical. The second vertical being DeFi. And DeFi is much more a crypto native community where they're developing kind of the future of financial infrastructure. The other folks paying attention to that are large investment banks. So, we're on a call very often with management committees of different investment banks. They're outside of wanting to understand the Bitcoin markets, because that's where the trading volume is. They want to understand the impact of decentralized finance on their core business lines. So namely things like synthetics, right? So how do decentralized synthetics impact their assets they're trading on a daily basis? It becomes a 24/7 market in just about every asset class. Decentralized lending pools for commercial banks, how does that impact their NIMs? So that's kind of that second pillar of the crypto ecosystem. And the third is really the consumer facing application of NFTs. And I think one of the most widely known one right now are NBA Top Shots, which was developed by the company I just mentioned, Dapper Labs. And it's built on top of their specific, more gaming oriented blockchain called Flow. And so it kind of flows through no pun intended, flows through the whole stack. And that consumer side of it has exploded. It's exploded the media coverage. It's frankly, made my life quite a bit busier than it would have otherwise been, with people asking me. It's kind of, it's interesting how there's so few people that understand what's happening and so many others that are looking to come in. You see that often in new attractive technologies, particularly consumer facing. So those are kind of the three verticals that you can roughly break the crypto ecosystem into today. We invest and trade both short, medium, and long term across all of these things. It is certainly a unique market insofar that it is more volatile than any other asset class that exists. It is uncorrelated to just about anything else in the macro ecosystem, and getting increasingly less correlated. And it's technology at its earliest stages. So everyone thinks they may have missed the boat. Even for Bitcoin, it is the earliest days for Bitcoin currently. When you think about DeFi and the NFT space, the economic models are still being built out. The technologies are sort of catching up. So it's an exciting space. It's information inefficient, and it's liquid, and it's very, very exciting. And I'm happy we're able to talk about it here on the panel today.
See if I can get off mute. Michael, just to follow up, you put in three verticals, which are interesting. So you put Bitcoin as sort of the macro trade, DeFi as the potential finance disruption, and then the consumer facing. Where do you put the platform protocols, the smart contract protocols? Do you put that in DeFi?
Yeah, so right now that's being primarily driven by the evolution of DeFi. If you look at any of the layer ones that have, if you're looking at the tokens and appreciation in their value, it's been effectively determined by the level of DeFi activity on the base layer protocol. So yeah, I would put that squarely in the DeFi camp, in that middle sector.
Yeah, I have to push back because there are a little bit of echo. I want to push back a little bit because you used a lot of terms there, and I'd love to just go back through that answer and make sure people understand. So talk about a smart contract platform. You don't really necessarily have to talk about smart contract per se. You can just talk about these are programmed. When you walk through kind of what Ethereum is for people in simple terms, and then let's build up the idea of layer one versus layer two with the ultimate idea of what's DeFi look like if the disruption happens.
Right. So layer ones are networks which trigger almost contractual agreements. So they're smart contracts. So basically they affect a change of state. What DeFi does, and you're building decentralized applications on top of that, is they're leveraging those layer one applications to transact on top of that initial layer. So what tends to happen, and you brought up layer twos, what tends to happen is if the bulk of decentralized application activity and transactions are happening on one layer one, I don't want to get too far down the rabbit hole.
That's right. I'll help translate when you're done. Keep going.
Okay. What happens is those specific networks, because of the consensus mechanism, it may stall out insofar that the network becomes congested. And so actually one of the companies I mentioned previously, Dapper Labs, that created Flow Blockchain, the CTO of that company, Dieter Shirley, created a decentralized application called CryptoKitties in 2017. And it was this interesting concept, and it was kind of the first viral decentralized application in this space. And it basically brought the Ethereum network to its knees. It congested the network to a point where it was almost unusable. We saw that more recently with the advent of decentralized exchanges and massive activity on Ethereum, where it became almost unusable from a cost perspective. So affecting transactions in any small increment of capital was cost prohibitive. And so what happens is those decentralized application layers will then move to the next layer one that they think is high quality, that has higher throughput, where the cost of transaction is quite lower, so their user base can sort of transport along with them and be able to transact in lower dollar amounts. And so for things like games, layer 2 has become incrementally important because that significantly decreases the cost of transacting on these platforms. I tried to keep it high level, but Paul, you can.
Yeah, no. Yeah. I just want to pursue this because I think it's important. So you said we've 3 verticals which we can use, and we spend a lot of time trying to categorize this so people can understand. And I happen to agree that Bitcoin is different than everything else. So it's its own vertical. You can call it anything you want. It's Bitcoin. And then we get into sort of technology and adoption of, because Bitcoin, if it continues to trade, it will never be used for anything other than trading because it's too volatile and it's too scarce. It's never going to be money, but it's going to be this macro trade. Okay, fine. And then you can do the consumer side, which is interesting. And the new NFTs, the Nifties, have come out. People being kind of blew everybody's mind. Top Shot. People have collected those sorts of things forever. People have collected baseball cards. People have collected art. People have collected. So that translates pretty well. This just might be a better infrastructure for that. And we'll have fads come and go. It seems that the real disruption is in that middle bucket. Disruption to finance, disruption potentially to legal. I'm going to have Donna kind of weigh in as well. And it feels to me a little bit like we have some first generation technology out there that's proving it out. I hate to use the analogy of AOL, but AOL sort of showed the power of a community, showed the power of email, showed the power of internet access, all kind of connected. And then better platforms came along. I mean, you guys are trying to make bets on that. Do you feel that this layer 1 may run out of gas and things will go to next gen layer 1s, or will build their own native layer 1s or things like that?
Yeah, so I mean, right now it's very early, even with Ethereum, which has been kind of the gold standard in smart contract layer 1s. We're now looking at new parts of the ecosystem that are emerging. So Polkadot, for example, is, some folks consider that to be a layer 0, where you can see the Ethereum blockchain bond to the Polkadot protocol via Parachain. So the interesting part, the nice part about this space from an investment and trading standpoint is that these affiliated and associated tokens are liquid. And so if you think about the traditional J curve of a venture investment, if you were able to basically mark to market every minute of every day the progress of a company in its path from 0 to success or 0 to failure, that's basically what you're provided here. And so again, it goes back to that kind of information and efficiency, understanding how different parts of the stack interact with one another. Understand that if you're talking to 20 decentralized gaming developers and they're all using Matic Polygon as their layer 2 solution, and that layer 2 solution has an associated token that's going to increase in usage significantly, you would then go out and acquire that. You would build a position in that name. I think
Michael, can anybody other than a professional do that?
Yes, with associated risks. So we have.
Wait. You get to spend 70 hours a week thinking about this. But if I'm somebody kind of watching it from the side, interested, believe in this disruption, how do I play it? I could play Bitcoin, that's that big master trade. But what if I wanted to play the DeFi? I don't have the resource to go talk to 20 gaming companies to see what layer 2 protocol they're going to use.
Yeah, and I'd imagine all the folks on Reddit didn't have time to go speak with GameStop managers. I mean, you said so you can trade it. You said can you? Should you is a different story. And I do think it is very much buyer beware in this space. The only thing I recommend to family and friends currently to buy in our space is Bitcoin and potentially some Ethereum. And I say, if you want to go crazy with 5% of it, go on Coinbase and fiddle around with some of those assets, but learn what they are. So at least while you're likely losing money, you're learning a bit more about the ecosystem. And with respect to Bitcoin, if they're willing to go a bit further down kind of the rabbit hole, we'll I'll get them the hard. I gave everyone the Satoshi anniversary wallets for Christmas a few years ago. I think having people understand and being part of the decentralized ecosystem is important. But that being said, if you want to play in the broader universe of the cryptocurrency ecosystem, it is very much an institutional process. So, we're a hedge fund. We're at, at a much smaller AUM level. We were 10 people. And if we were to be a traditional hedge fund at our AUM at that point with 10 people would have thought we were out of our minds. But you need that type of operational leverage to account for every risk in the space, to not only generate alpha through ideas and trading, but also just really account for operational risk. And that's the biggest risk, is the risk of ruin, the risk of complete loss. And there's a lot of layers of this. The beauty of cryptocurrency is the decentralized nature of it and the self-sovereign nature of it. But the biggest risk is just the same. So, Donna,
no, I was going to, add on to what you were saying, which is in part the fact that it's a professional market in the DeFi space is what is allowing it to continue to operate. Because if you had a huge inflow of retail people, you would now have the government, the regulators come in and say, whoa, we have to take a look at this. They are purposely allowing a lot of experimentation in a way that they might not allow it if there were a lot of retail people in this space. We've recently seen some heads piping up with some additional notice as saying that the on-ramps, the off-ramps, a lot of these things need to be made sure that everybody is complying with KYC, AML, anti-money laundering, all of that going on, even in the NFT space where the big money is moving around. So I think that the longer that these experimental protocols can be worked out and the bugs in the smart contracts, which end up in exploits, happen within the professional community, I think you have some cover from the regulators. And I do think that that's an important thing to work on and do at this point.
Donna, the follow-on question to that, are the regulators crypto friendly, crypto neutral, crypto negative? What do you think?
Well, okay, so I have to say that we have new regulators coming in. Gary Gensler, who formerly was head of the CFTC, most probably will be the head of the SEC. He taught crypto and blockchain at MIT. He knows this industry. There's no reason to not believe that he will be at least knowledgeable and friendly in this. Does that mean that everybody gets a blank check? Absolutely no. We have a good regime under the CFTC. They're pretty knowledgeable. We have a number of products that are trading on regulated exchanges, and that will increase. The CME just announced that they will be doing Bitcoin, I'm calling them minis, but they're a little smaller contracts that have been before. And I think the issue we have here, again, is the same KYC, AML, bank secrecy, which is what Janet Yellen at the Fed has talked about in terms of the bad guys. Now, just be clear on the bad guys, leaving aside nation states. It has been shown over and over and over again that it is much easier to trace crypto than it is to trace cash. And there are a number, of very good companies that work with exchanges and work with the government to have caught people that they normally would not have caught, that were using Bitcoin, and they would have normally used cash for illicit activities, trafficking in all kinds of things and people. So I think that is kind of getting dispelled along the way as a serious risk. With the last week, you had all of the major regulators and heads of central banks in the BIS, Bank of International Settlements, a symposium that was 5 days. You had Jerome Powell talk that Bitcoin was replacing gold as the standard, as the hedge, and the store of value. You had a lot of discussion about central bank digital currencies and how all the countries were shaking out on that, and stable coins. So the most of the symposium was about digital technology and digital assets, which I find incredibly interesting, in that every single one of the regulators were focused on this and ways of using it, not ways of preventing it, ways of thinking, how do we incorporate this in a way that's beneficial to the global population and to our ability to help our citizens manage the currency risks, et cetera, within our government. So, and just to say, in both of the House and the Senate original COVID legislation was a digital dollar. Of course, they retraced on that because we didn't have the systems and the protocols and the blockchain and everything ready for that. But both versions had that in there. So we're getting ready for a more digitally oriented, crypto-based society. It will take a little time, but we'll get there, is my opinion. Sorry.
No, that's great. Great. Michael, back to you for a second. So, we're a school of higher education and you went there, and I know you feel extremely appreciative of the education you had at Fordham, and we very much appreciate you coming back and sharing your insights and your time. This is critical. Is it possible for somebody to be very bullish on the technology, orienting their education that way, to look for the disruption and opportunity and not have to trade the tokens? Can we separate the speculation around this new asset that's hard to understand why it goes up and down so much from perhaps the disruption we see? I've been teaching this for 4 years. I know, Donna, I think you've been maybe even longer than that. The school's been teaching crypto for the better part of 6 years. We're trying to make sure the students get all kinds of perspective on the technology. But is it possible, if I'm a student and I say, look, there's too much, I don't have any money, I'm a student, or the assets are too volatile, but I'm really excited about it. Is it okay if a student is not a participant in the speculation, but is very much a participant in the technology disruption? Is that okay?
Yeah, without question. I think, and Fordham's doing a great job of that, right? I think it brings together a few of the core tenets of the Jesuit education, which is, I mean, everything from philosophy to technology, law, finance. It's really game theory. There's a lot of very interesting collaborations of field of study that cryptocurrencies bring together, and you can attack it from a million different angles. That's the most exciting part about this. It's easily one of the most pervasive technologies to come about. I mean, I think everything in the forward will have some form of distributed ledger technology attributed to it, particularly in the fintech space, which is kind of the tech of everything at this point. And yeah, I mean, listen, when we first launched Block Tower, when we scaled that first year, we were hiring folks from Bridgewater and Citadel and other kind of proper institutions, and you come to realize, and over the years we've had some restructuring of individuals. You don't realize your implicit biases until you've kind of been proven wrong, and so our firm now is oriented around folks who have primarily dedicated their lives to the space. And so, some of the most talented folks on our team are, guys and girls who have been in this space since their days in college, since the university days, who have been founders and creators and studiers of the industry, have been trading in the industry since university, and have been fully crypto native since they graduated. So there's certainly ways, and now the industry has gotten itself to a point of being well capitalized enough for a student to feel okay going into the industry and taking a risk. When I was graduating, the big risk was going into finance. You said it's sort of it's fill or kill. You either you perform or you exit, and that is kind of what finance has become more of the steady business. Although the last few days maybe not as much, but it's been more of the steady business. And now these emerging spaces like the cryptocurrency space, blockchain, distributed ledger tech, are those new versions of what finance once was. So ultra competitive.
The one thing that drives me crazy about crypto is that there's this idea that if you don't get it, it's because you just don't get it, as opposed to we can't get there by first principles. And that's the thing that I meet a lot of people in crypto, and they say, no, you can't get there by first principles. You just have to believe. And it's only those that grew up with it that truly believe. And it's just like, well, we haven't repealed the laws of gravity. Until we do, guess what? Donna's world is going to be a factor, right? The law will be a factor. Regulation will be a factor. At the moment, they've decided to sit on their hands. Right? She said, however, if certain things fall certain ways, they're going to be there very quickly. The law of economics will go. Bitcoin is not gold, because gold's been around our culture for 5,000 years. Bitcoin's been around for 12. So I mean, that's sort of the case. We're going to turn to a lightning round on.
Yeah,
Donna, go ahead.
I just want to say, I mean, because I know we're at a business school, but Michael will agree. I mean, there are huge issues that need to be solved, and we need smart people to solve them. We need people that know tax. I mean, this whole regime has to be organized and structured in a comprehensive and rational way around tax. And that tax is tax, that's on a day-to-day tax, that's business tax, that's inheritance tax, that's down the line, every single thing. We've seen in the last week, companies like PayPal and Visa, and we saw just recently BNY Mellon, JP Morgan, Goldman Sachs, all of them, these companies going into this arena in one way or another. And so, and I don't want to sell short also not only the crypto, but the blockchain. There are companies that are using blockchain for supply chain. All of the things that happened during COVID, many of the resources that were scarce resources or fraudulent resources could have been checked if there were really sustainable blockchains that were global, and we would have known that money that was being spent on masks were fake masks, or they came from, et cetera, et cetera. So I do think that, the opportunities here for business students and obviously for law students here are enormous, because it's all a huge startup that is growing and needs solid people that have great educations and a desire to be in this new economy. I think there's just so much, and I don't know, Michael, what you say to that.
Yeah, I mean, the two defining moments looking back that were clear as day was, I remember, 2008, walking out of the Goldman Sachs front door into Occupy Wall Street crowds. And that was kind of a genesis or defining moment for what Bitcoin represented and emerged out of. And I think what we had earlier this year with Robinhood and Wall Street Bets was very much a defining moment for what the decentralized finance community is now. That's kind of what drives the community. And so I think about, I would say it's, coming in 2007, 2008, as a person going into finance, you were driven by, capitalistic instinct. Even more so now than ever, with the people even that are part of Block Tower and kind of the younger, newer cohort of people entering the industry, it's more philosophical for them, which is even more interesting because you can create this, new economy through a very passionate philosophy around decentralization. So again, it's pervasive. You can look at it from 100 different ways. And I think, Paul, your question, there are many times where I hear something on a conference call with, in a meeting, and I turn to one of, a number of people at my firm and say, what does that mean? And I've been in markets for a long time, so it's easy for me to understand markets and how markets operate. But there are certainly many, many things that I am still not comfortable after 4 years, 6 years in the space, 4 years full time, that I'm still not comfortable with, which is why you surround yourself with that expert network and community.
Yeah, I agree. All right, we've got a couple of questions from the audience. I'm going to do a quick and we'll do a lightning round. Well, while blockchain seems so compelling, why has it been so slow to take off?
Friction, operational friction. I think with private blockchains, like Donna mentioned, some, blockchains that are focused on supply chain management, it's getting a group together to all agree to leverage the same base layer technology, and it's transparent, and I think with most companies, the idea of proprietary information and information advantage is important. So opening up information transparency, even amongst a smaller group, is difficult. You're starting to see that now. You have large investment banks that are focused on the repo market, as I mentioned to you in another conversation. You have, I think there's been a group of investment banks that have been building on the Titanium network, which has been used, I believe, for FX swaps for a few years now. So, and then you're starting to see, I'm a mentor for a few accelerators, one of which is more focused on industry or enterprise focused blockchain. And so we see a lot of it across agriculture and other industries. It is really just getting a few of those to focus on changing budget is a big enough of a hurdle to basically replace your technological infrastructure is a whole nother can of worms. So you really need progressive thinkers in a corporate environment, which is not necessarily the easiest thing in the world. Donna, you may have some views on that as well.
No, I think that also, these big companies like PwC, Ernst & Young, et cetera, a lot of them have been working, but now they have to figure out how do they take that and they turn that into sales. And sometimes, the lag between having created ideas and rationales as to why clients should use this, or Ernst and Young doing the night application. It takes a little while to be able to translate that down to also very dense hierarchical structures to realize that they really need to do this. And this is not new in technologies. This happened before, and and it's not going to be the last time it happens. But when it does catch on, there will be a huge adoption across major corporations, banks, financial systems, and an increase in learning in universities. So get there first.
Follow-on question, is all the energy that Bitcoin consumes worth it? No.
This is a raging debate in the institutional community facing off against the crypto community. So there's been a lot of good data pulled on both sides. If anyone wants to look up kind of one of the leading defenders of the crypto ecosystem, you can read up Nick Carter's. Nick Carter has a firm called Castle Island Ventures. He's done a lot of great work on the usage of energy and I think the defense of Bitcoin. But Paul has a view too, I'm sure.
No. Next question. No, I mean, you think it's bad now. Wait till the coin's at $150,000. Wow,
Yeah.
That's gonna be a disaster. And by the way, everyone talks about the chain being secure. It's the energy part of this that's not secure, because guess what? The weak link is the controller at the local energy power supply company that can in fact be hacked. So how about this? Go short Bitcoin and then close down a couple of mining pools, and you're gonna make a lot of money. Do you think that Bitcoin will replace US dollar? It's always an interesting question. What do you mean by replace US dollar? In terms of transactions, no. As a reserve currency, I don't think so, but other people do.
Yeah. I would say that, and I had a good conversation with Richard Haas, who's the head of the Council on Foreign Relations, a couple of years ago on this at a conference. And I think that we have a basket. I think that it's not a Bitcoin versus dollar, but the dollar has lost over the number of years a lot of its front and center as the country has migrated away from being front and center.
Donna, I looked up the number. I just have to push back. Sorry to interrupt. I have to push back, but the US dollar as a percent international trading is up over the last 10 years, and it's flat over the last 20. So
but the value is down.
No. I'm just in terms of the dollar volume as a percent of global trade. It is up over the last 10 years, and it's flat over the last 20 years. The euro's lost, and the yuan is increased by modest amount. So, I mean, people say that all the time, and they also say that this is an inflation hedge, and we've had no inflation. So, I mean, I agree, but it's just the facts are in.
So I don't think it replaces as a U.S. citizen sitting in a country with a reserve asset as my currency and a stable financial system. It'll never replace anytime in the near term my U.S. dollars. But similar to your chart that you showed earlier, I want to hold my Bitcoin. I'm not going to buy a Tesla with my Bitcoin. I'll buy a Tesla with my declining asset. I'll buy I'll buy anything on the PayPal merchant site with my US dollars, not my Bitcoin. But if I'm sitting in an unstable environment, it's unstable political environment, I don't trust my banking system, I don't trust my currency, I think that's where.
But Michael, but even in those, sorry about this, even in those environments, you're not going to trade. You'll hope Bitcoin will be your store of value. You'll convert it to the local currency as you need to transact. You won't transact in Bitcoin.
And even with that, I mean, that's kind of that's hypothetical, theoretical, I should say, because most, people always point to Venezuela, and Venezuela, they don't convert to Bitcoin. You can look at local Bitcoin's volumes in certain environments, and most people are converting to US dollars. There was a massive increase over the past few years during politically unstable environments in stable coins on exchange. So stable coins are, effectively, tethered to the US dollar, not.
Yeah, exactly. They're the gateway drug.
Not tethered, they are tethered to the US dollar, but tethered is a type of stable coin. But I think stable coin volumes are a reflection of political instability. And those regimes will always kind of pull forward the idea of what is a good store of value if my dollars in my local bank, one, are not protected by the local bank, or two, not protected by from inflation. So
Yeah. No, good call, Michael. Follow on to that. U.S. government or somebody issues a government-backed digital currency. Does that take the enthusiasm out of crypto?
So one of our advisors is Christian Carlo, who I think, Donna, you know as well. He was the former chairman of the CFTC. He has focused exclusively since he left government on a U.S. digital dollar project. I think there are going to be, China's already been rolling out their digital yuan to citizens. It's in use. They've distributed hosted wallets. There's actually been great research done on this by the Goldman Sachs Asia economics team. Digital dollars will come about simply from a function of monetary policy, whereby actually there's another Goldman report saying that a digital dollar would allow for a negative interest rate environment much more seamlessly than a fiat environment. And we can run through the reasons why, but I don't think that people are viewing their Bitcoin holdings. A digital dollar can be printed just as easily as a fiat dollar. And in some cases more easily, and distributed to the economy more seamlessly. I don't know my Bitcoin because I own Bitcoin because I don't want to be in a dollar.
You own Bitcoin because you think it's going up.
I own Bitcoin because I think it's going up in my currency. So like any asset. So I don't want to own the dollar.
Wait. Hold on. It's a speculative asset. You're not betting. You're not short the dollar. You're long Bitcoin because you're a believer in crypto.
Well, in being long Bitcoin, if it's BTC USD, I'm in the same breath short the dollar.
Well, it's the same. Then your house is short the dollar. The one you just put it. You're going to move. You're going to buy a new home. You're going to be
Absolutely.
short the dollar. Every stock you own is short the dollar. I mean, let's be careful.
I think so realistically, I have at some point in this world of cryptocurrency shifted my view on the cost of everything as a function of some other currency. So the reason that a Luka Doncic rookie card, a 3-year-old rookie basketball card, went for $6 million at auction, I don't think that card actually appreciated that much. I think the value of the dollar is depreciated more so than the appreciation of that rookie card, or at least the.
Wait. Hold on. Let's do the math. Michael Saylor goes into Bitcoin as an inflation hedge. So you say to Michael Saylor, all right, how much inflation do you think is coming? He says 15%. That we've never had a year of 15% inflation in the US dollar in the history of the dollar. Right, so, hold on. So Michael Saylor, how many years of inflation do you think? I want 5. That's 75% not compounded. His position's up 250%. He should be selling his Bitcoin because the hedge worked.
Michael, and I think he's great. He is maniacally focused on his investment case for Bitcoin. He's down here. We were speaking last week. There's nothing else you can input into his views of the macro environment or the cryptocurrency space outside of we're printing 15% of US dollar monetary supply a year. So it's not inflation. He's not looking at like the 5-year break even and saying we're going to be, skyrocketing to 15, right? He's looking at dollars. So percent of dollars printed on existing capital base. And that's where he's getting that 15% number, which is not, obviously the terminology is mixed up, but his view is it's very much simply a function of supply and demand. You've got this ever increasing supply of US dollars, which is an unknown. I mean, I'm not going to sit here and say they're going to print 15% more supply of US dollars every single year in perpetuity. But I do feel more comfortable in the supply curve of Bitcoin relative to US dollars. And I do think that the demand profile for Bitcoin will increase significantly higher than the demand profile for US dollars as a delta of the existing demand. So
yeah, of course, right. I completely agree, but that just means that you're betting that the increase in demand for Bitcoin will be greater than the increase in supply at a faster rate, which makes it a speculative asset, and you're long that, and there's nothing wrong with that. But the rest of the
no, but also, Paul, in contrast to the fact that that the amount of dollars that are in circulation keep going up, whereas the supply of Bitcoin is fixed at a certain amount, 21 million, and it's not going to go up.
The dollar part of that argument's irrelevant.
Not really. So if
Michael, you wait. You would still be long Bitcoin, even if dollars were not increasing at all.
yeah, it's relative value.
Right. So the fact that dollars are increasing is irrelevant.
But his conviction,
No, stop.
possibility of Bitcoin.
No, that's actually accurate. I'm fairly conservative. So this industry is actually great for me because I'm fairly conservative by nature. And so it allows me to kind of blend out into a more, I would say further out the risk curve than I generally otherwise would be. And last year I was, I was sitting on a lot of cash, and I at a certain point gained significantly higher conviction in holding Bitcoin relative to dollars. And that conviction was premised upon the increase in demand relative to the existing demand for Bitcoin plus a fixed supply curve relative to the declining demand to hold US dollars because of expected money printing relative to the demand, relative to the supply curve of which is, I guess, is a function of itself. But I was higher convicted in holding and owning Bitcoin and cryptocurrencies because of that. And the other, it's not a good argument, but there's I made it to that.
I know. Dean's going to pull us. I have one follow-on question. Can we call you back in 5 years? And when inflation did not accelerate in the US and the dollar's purchasing power is basically the same, you will admit that that thesis was wrong.
And Bitcoin will be worth $1 million a Bitcoin, and he will say, "Okay, I admit."
Right, but that's what I'm saying. What I'm trying to point out. Yeah, but what I'm pointing out is that the dollar part of the argument's irrelevant.
Well, listen, my working capital probably isn't going to be Bitcoin for some time, maybe not in my lifetime. So I guess what you're getting at is accurate in a sense of my life's working capital will continue to be US dollars. Actually, the biggest change, and Don, I'll let you go in a second. The biggest change in this market is actually happening currently. And Alan Lane, the CEO of Silvergate Bank, just referenced this. There's going to be the ability to borrow against your Bitcoin holdings from regional and regulated banks.
Exactly, and that is such a disaster that it's just frightening to me.
It allows for your
let's take an asset. Let's take an asset that's more volatile than any asset we've ever traded in capital markets and let people borrow against it. That sounds like a really good idea.
I mean, the banks, well, if they're good risk managers, they'll hedge out that volatility. You've got CME products.
I'm not worried about the banks, Michael. I'm worried about the people that borrow against their Bitcoin.
Yeah.
So I was going to jump in, and it sounds like Paul already answered his part of the question. And my question to each of you, my final question was going to be, in the crypto world, what's keeping you up at night? And it sounds like for Paul, it's the borrowing side. What about Michael or Donna? In the crypto world, what are you concerned about? What's keeping you up at night?
Asian market hours.
Great answer. And
I think mine is kind of like what Paul was saying, but a little bit of the converse, which is leverage in the DeFi markets. And these are professional people, but there's so much leverage and there's so much experimentation that when something happens, an event happens, it's a black swan, almost immediately. So I don't stay up at night because I don't really trade. But if I were going to think about what the problems is, that would be a problem.
Donna, I will add to mine. What I worry about is just the speculative nature of it. The technology is incredibly powerful. This is what I teach it. I'm very passionate about teaching it. I tell the students, look, you've got to know this. This is big. But the speculative nature around the tokens does keep you up at night. For normal people, look, Michael's a professional. He can do whatever he wants. Paul Tudor Jones has been doing this for years. It's when my very dear friend the other day, who's never owned a stock or anything, called me up and said, should I be buying Bitcoin? That's what keeps me up at night.
Well, I think Michael said it earlier, buyer beware, but this was a great conversation. And there are a lot of questions in the chat, which I think will circulate to the panelists and see if we can get some answers, and we'll post them on our website. I want to invite everybody next Wednesday. We'll have another really exciting conversation on SPACs, special purpose acquisition companies. And we invite everybody back on Wednesday, April 7th at 6 p.m. And thanks again. Thank you, Paul. Thank you, Donna. Thank you, Michael. This was really great.